Welcome back. Actually, the banks have bounced somewhat, but mid-caps have bounced even better. At an index level, it's about 1.1% higher, and that's brought the advanced declines a little closer. We had a slightly higher declining proportion to advances. Now that's narrowing a bit. So the mid-caps are kind of getting a little bit of their mojo back. But one stock that certainly is going to help would be L&T. L&T Finance reported about highest loan growth in 8 quarters, and that drove the earnings ahead of market estimates. To discuss more, Dinanath Dubhashi, the Managing Director and CEO of L&T Finance Holdings, has joined us. Good morning, Dinanath. Thank you very much. Well, the balance sheet growth has remained very strong, 25%, and obviously that's because of the big growth in disbursements. Can you maintain this pace in terms of disbursements and AUM?
The AUM growth indeed has been very strong. It is coming from good growth in all the businesses. We have said 2 years back that the way we will grow is by improving competitive positions in each of the business that we are in. That is what has happened. But even within this 25%, what is interesting is the retail asset growth is much higher. So rural has grown at 60% plus. Housing has grown at 50% plus, and wholesale, as we had always said, we keep the AUM growth limited to in the teens. So the wholesale growth is about 13%, getting the overall growth rate to, as you rightly said, about 25%. We expect this trend to continue, though I would like to put one note of caution that there is a base effect also into play. If you would remember last year, the last 5 months of the FY17 were the post-demonetization months. So while the growth will continue to be robust, we should not sort of project the same growth percentages into next year. However, having said that, 2 things will happen. Growth will continue to be robust, and the movement of the portfolio towards rural and housing from wholesale will continue.
Okay, Dinanath, good morning. There was sharp improvement in gross NPAs. Did you sell the NPAs?
NPA management is always a mix of everything, but this time it is very, very clear. The NPAs have improved in all the businesses, but the hero clearly is the rural business. I have indicated it in various press interactions without giving the numbers, but now we can talk about the numbers. So the rural NPAs, whereas the overall NPAs, as you said, have improved quite well. From last year, the gross NPAs have improved from 7.11 to 4.8%, and net has improved from 5.02 to 2.3%. When you talk about rural, last year rural gross NPA was around little about 12%. Today it is just about 6%, and the net NPAs from 9.7% around has fallen to 2.6%. So rural has been the hero.
Okay, rural has been the hero. That's good to hear always. The defocused book continued to decline and now forms less than 2% of the overall book. By when will it, go to nothing? When will it become zero?
It really doesn't matter. Naturally, the pace will come down because whatever is collectible normally gets collected, and what remains will have to be provided and written off. It's a matter of corporate policy. When do we actually choose to take that write-off? It will be P&L neutral because we would have already provided for majority of it. Let's say it will become less than 1,000 crores this year, and then maybe completely disappear by FY20.
Okay, but Dinanath, the interest rates have climbed, yields have climbed. How do you see the cost of funds for yourself and therefore the net interest margin moving ahead? Will you be able to pass on this higher cost to your customers?
So there is a tactical answer to that. That definitely yes, the way NIMs will vary is based on the way I will be able to pass it on, and also my ALM management, right? We have managed our ALM quite well. Our economists saw this increase coming 2 quarters in advance, and we moved quite a bit of our treasury from CPs to NCDs. So today we are placed well, that we have a positive gap on our balance sheet. Higher percentages of our assets are repriceable more than the liabilities. So we are today in an advantageous position because we have a positive gap. So certainly, but there is no doubt that cost will go up. Part of it we will have to pass on. We have already taken a 15 basis points increase in our home loans pricing, a 25 basis points increase in our infra pricing. So as and when possible, we will pass on a part of it. But more importantly, the strategic call that we have taken is NIMs will certainly go up and down. We will try to manage it our best. But using fees as the second source of income has been the strategy for the last 2 years, and I'm glad to report that in FY18 our NIMs plus fees is the ratio I always talk about, has improved from 6.5% in FY17 to about 6.9% in FY18. Our endeavor will be to keep it that 6.7 to 7% range throughout, despite the cycles. And if you are able to do that, profitability will be safe.
Okay, finally you raise money in Q4. Where's your capital adequacy now, and for how long will it suffice?
Our capital adequacy ratio is now quite robust. It's, when we raised it, it was just above 15.5% or something. It is close to now in high teens, 18 to 19%. And we are sure that with the growth rate and the profitability that we are showing, minimum of 2 years is what we believe the capital will be adequate. What is very important is the way this capital is being used. And as I said before, a majority of this capital is going for growth in rural and in housing, and a very small part to growth in infrastructure. And this change in portfolio, what we call retailization of our portfolio, which is like 33% was rural and housing 1 year back, which is now 42% and should grow closer to 50% by next year. We believe that will lead to the profit growth that we are aiming to achieve over the next 2 years.
Thanks a lot for that. Well, IRB Infra is the next company that's on our radar.